Gold isn't getting more expensive. Your money is getting weaker. That's the contradiction sitting at the center of this story. Gold looks like it's rising fast, but what's really happening is quieter and more dangerous. The rules underneath the system are shifting, and most people don't see it yet. In 2025, gold didn't just climb, it surged 65%, the strongest year since 1979. By early 2026, it was trading near $4,800 an ounce. And instead of panic, the market stayed calm. That's the part that matters to you. Because when an asset goes up this fast and nobody rushes for the exit, it's no longer a trade. It's a signal. Corrections don't scare buyers anymore. They invite them. This isn't money chasing headlines. This is money repositioning for survival. Think about that. If the price floor is already well above $3,000, then the old idea of safe haven is gone. Gold isn't hiding from risk anymore. It's standing against something, against systems, against currencies, against promises. And here's the part nobody is saying out loud. When an asset becomes a statement, the price stops being the story. The reason people need it becomes the story. What just happened didn't start in 2025, and it definitely didn't happen in isolation. The surge in gold is being treated as a headline event, but that framing misses the pattern underneath it. This wasn't a sudden rush caused by fear or a single crisis. It was a gradual shift that finally showed up in the price. Analysts now describe gold as a statement trade, not because of emotion, but because of positioning. It's being accumulated as a sovereign asset, separate from the US-centric financial system. Here's a concrete detail that matters. After the 65% gain in 2025, gold didn't collapse. It reset. The market established a pricing floor well above $3,000 an ounce and kept moving. By 2026, levels near $4,800 weren't treated as extreme. They were treated as confirmation. Pullbacks were bought almost immediately. That behavior doesn't show up in speculative manias. It shows up when capital is reallocating. Now notice what's missing from this story. There was no broad panic, no sudden shock. So ask yourself this: if gold isn't reacting to fear, what exactly is it responding to? Because this is where the issue stops being about gold and starts being about the system it's being positioned against. Here's the claim that makes this uncomfortable. Gold isn't moving because investors expect a recession. It's moving because the market no longer believes fiscal discipline is coming back. And the evidence is hiding in plain sight. Developed countries are drowning in debt, and there is no political scenario where that reverses. Analysts tracking institutional flows point to the same factor over and over again: developed country debt issues with no plan to fix them, no serious effort to reduce deficits, no appetite from voters, no incentive for politicians. That matters because debt doesn't sit quietly. It has to be serviced. And when it can't be paid honestly, it gets paid indirectly. This is where gold enters the picture. Not as a bet, as a baseline. Analysts describe the shift bluntly, calling it CFA Level 1 portfolio management. In other words, this isn't clever. It's defensive. Capital is rotating away from treasuries and fiat exposure, not because of panic, but because the math no longer works. Servicing expanding sovereign debt requires monetary accommodation, and monetary accommodation means dilution. Now, notice what they didn't say. No one is arguing that debt will be paid down. No one is modeling a return to restraint. The market has already moved past that debate. Gold is being priced as insurance against a future that policymakers won't publicly admit is locked in. And once insurance demand replaces speculation, the behavior of the price starts to change. Now watch how fast this escalates. When fiscal discipline disappears, markets don't collapse immediately. They adapt, quietly. And one of the clearest signs of that adaptation is normalization. Things that would have been unthinkable a decade ago now pass without comment. Trillion-dollar deficits, permanent rollover of debt, central banks trapped between inflation and insolvency. None of it triggers shock anymore. We've seen this movie before, just not at this scale. In past cycles, debt problems were isolated to a country or a region. Today, they're synchronized across developed economies. That changes the response. You can't outrun the problem when everyone is running the same direction. So instead of fleeing, capital looks for insulation. This is where gold's behavior becomes telling. Price spikes used to signal stress. Now they signal acceptance. The market is treating elevated gold prices as normal, not temporary. That's a psychological shift, and it's dangerous to ignore. When something abnormal becomes routine, it usually means the system has already adjusted underneath. Here's why that detail changes everything. If elevated prices are normalized, then future stress doesn't reset the market lower. It builds on top of an already higher base. Each new shock stacks on the last one. And that's how a slow structural problem turns into a rapid repricing event. This is where the evidence stops being abstract and starts getting heavy. Central banks aren't talking about gold. They're taking it. Year after year, net purchases have pushed toward 1,000 tons annually. That's not a rounding error. That's roughly 1/3 of all global mine supply being removed from the open market by institutions that don't care about short-term price. These are not traders. These are reserves. Here's the contradiction that matters. Publicly, the financial system still talks as if the dollar sits at the center of everything. But quietly, reserve managers are doing the opposite. They're reducing dependence on U.S. assets and replacing them with something that has no counterparty risk, no sanctions risk, no settlement risk. Gold doesn't need permission. And notice what this buying doesn't do. It doesn't recycle supply back into the market. Central banks don't flip positions. They lock metal away. That creates a hard floor under prices because a large portion of annual production is simply gone before private investors even get a chance to compete for it. Here's the line that changes how you see this. When price-insensitive buyers absorb 1/3 of supply, the market stops being balanced by sentiment. It becomes balanced by scarcity. Any new demand from institutions or individuals now has to bid against a shrinking float. This isn't bullish psychology. It's mechanical pressure. And once scarcity, not speculation, sets the price, the next phase doesn't move slowly. Now the pressure starts stacking. At the same time gold is being absorbed by central banks, the system is picking up a second, quieter instability: energy. Global oil markets are entering 2026 with inventories near 10-year lows across crude, gas, and diesel. That alone would be uncomfortable. But here's the twist. Money managers are barely positioned for it. Exposure is historically light. Protection is thin. This is a classic pain trade. When inventories are low and positioning is complacent, it doesn't take much to trigger a scramble, a disruption, a bottleneck, a geopolitical flare. Prices don't grind higher, they jump. And when energy jumps, inflation doesn't politely wait for policy meetings. It spreads. Now connect that to gold. Higher energy prices push inflation up and real rates down at the same time. That double hit removes the opportunity cost of holding gold and reinforces its role as protection. It also raises mining costs, which quietly lifts the floor under metal prices across the board. Notice how fast the loop closes. Energy shocks feed inflation. Inflation pressures policy. Policy weakens currencies. And gold sits at the center of that chain, absorbing the stress. What happens if this continues? Because once multiple stress points move together, control doesn't fade gradually. It snaps. At this point, the story stops being abstract and starts touching real life. Because none of this stays on balance sheets. It leaks into everyday decisions. When gold reprices like this, it's signaling pressure you eventually feel in savings, in purchasing power, in the quiet realization that money doesn't stretch the way it used to, even when the numbers say the economy is fine. You see it when energy costs rise and don't come back down, when food prices reset higher and stay there, when housing, education, and insurance feel permanently out of reach of previous expectations. These aren't shocks anymore. They're adjustments, and they land on you, not policymakers. Here's the uncomfortable part. Gold isn't reacting to hardship. It's front-running it. The capital moving first is institutional and sovereign, but the consequences arrive later, downstream. By the time the effects are obvious, the repricing is already done. If this feels familiar, say so in the comments, because what's really happening is a transfer, not of wealth, but of timing. Those who move early protect purchasing power. Those who wait experience the change as loss, even if nothing crashes. And that's why this isn't about ideology. It's about how systems shift pressure without announcing it. Here's where the picture sharpens, and it gets less emotional and more unsettling. This isn't chaos. It's mechanics. Systems behave this way when incentives break. Governments are incentivized to borrow. Central banks are incentivized to stabilize, not to cleanse. Financial markets are incentivized to chase yield until risk becomes invisible. And in that environment, assets don't rise because people love them. They rise because they sit outside the leverage loop. Gold works here because it doesn't rely on confidence. It doesn't require growth. It doesn't need a counterparty to behave. That's the mechanism most coverage misses. Power in financial systems isn't about returns anymore. It's about optionality. Who can opt out when stress appears? This is why gold is being treated differently than stocks, bonds, or even real estate. Those assets are tied to policy choices. Gold isn't. When incentives push policymakers toward accommodation, gold benefits automatically, without needing a narrative. Here's the unsettling insight. The system doesn't need to fail for this to continue. It only needs to persist. Stability under these conditions becomes inflationary by default, and inflation quietly transfers value without triggering alarms. That's why this feels smarter than panic and colder than optimism. It's not about collapse. It's about adaptation. And once adaptation becomes permanent, the trajectory stops being reversible. From here, the path forward splits, but neither option resets the clock. One path looks calm on the surface. Growth slows, debt rolls over, policy stays accommodative, and inflation remains managed. In that world, gold doesn't explode upward in a straight line. It grinds higher, pulled by steady accumulation and quiet reallocations. Prices drift toward the upper targets, not because of fear, but because nothing arrives to pull capital back into trust-based assets. The other path is messier. An energy shock, a geopolitical fracture, a policy mistake, something small that lands on a system already stretched thin. In that scenario, repricing accelerates. Gold moves fast, not as a trade, but as a reflex. Liquidity vanishes briefly, volatility spikes, and the market jumps levels instead of stepping through them. Notice what both paths share. There's no return to the old baseline. No scenario where debt shrinks, incentives reverse, and confidence re-anchors. The difference is only speed, slow recognition, or sudden realization. And here's the key detail. Markets usually move before narratives catch up. By the time explanations feel obvious, positioning is already crowded. The next move isn't a question of if, it's already forming. The only uncertainty left is how abruptly it arrives. Here's the insight that ties all of this together. Gold isn't forecasting disaster. It's pricing permanence. A world where debt doesn't reset, where policy can't tighten without breaking something, and where geopolitical friction never fully cools. In that world, The most valuable asset isn't growth, it's insulation. Gold isn't winning because it's exciting. It's winning because it doesn't depend on trust staying intact. Reframe the story this way. This isn't a gold bull market. It's a confidence bear market. And gold is simply the clearest mirror reflecting that shift. That's why the numbers people argue about, 5,000, 6,000, 7,000, aren't the point. They're symptoms. The real story is why those numbers no longer feel extreme to the institutions setting the price. And this is where the loop stays open. Because gold is only the first signal. Other assets are still catching up to what it's already saying. If you want to understand where this pressure moves next, and which parts of the system haven't repriced yet, that's what we break down here. Follow, subscribe, and stay with the analysis. The next move doesn't announce itself. It reveals itself.